Warren Buffett himself, who was his student. Benjamin Graham, also I should emphasize, looked at portfolios of stocks. It's not just an individual stock picker, but he also advocated that it made no sense for individuals to try to pick individual companies, but you want a portfolio of stock that holds similar characteristics. So the first thing that he did is he generally limited the stocks and excluded technology firms. He wanted to see that stocks were reasonable size. He wanted to see scaled up to today's inflation of the size of about $340 million of sales of the company. If it didn't pass that, he wouldn't go for the stock. Current ratio of the company, he wanted to see it greater than 2, which is a pretty high criteria, unless the company was actually a utility or a telecom, in which case he could accept a higher ratio. Long-term debt, as I mentioned, again, one of the things that was common to almost all the gurus is they had some kind of criteria regarding debt. We wanted to see that it was less than the net current assets. So this is a pretty stringent criteria for most companies to pass. So it's actually saying that with all the long-term debt of the company, if you take basically the net current assets or the cash of the company, it could actually pay off its long-term debt. Long-term earnings per share growth, he didn't have a tough criteria. He just wanted to see a 30% growth over a 10-year period of time, which comes down to like about 3% per year. He wanted to see a positive bias in the companies, not a negative bias. And if it was any negative years, he would eliminate that company. Price to earnings ratio, he wanted to see less than 15. One of the things that's interesting in terms of how he applies it is rather than using the trailing 12 months of earnings, he actually looks over a 3-year trailing period of time. Had a price to book criteria of less than 22. And the total debt to equity ratio for industrial companies wanted to see it less than 100%, and for utilities, phone companies, railroads, et cetera, wanted to be less than 230%. And I need to go back here. So some real-time picks right now from his portfolio. I'll just pick a few interesting. Chevron Corporation is on the list right now. Telecom NTT Docomo in Japan. And Holly Frontier Corporation, smaller cap company, probably won't recognize. And another one, the companies that have been hammered recently have been in adult education. Bridgepoint Education Company has come to a point where that's attracted a very good value reputation under the Benjamin Graham criteria. So there are several other aspects that make these long-term strategies work and continue to work. And I wanted to share that framework with you. These are, we call them investing pillars, and they're an important part of the success of these portfolios and strategies. Basically, we've redefined long-term investing. You don't have to hold on to the stocks to be a long-term investor, which goes across against your conventional wisdom. You have to hold on to the strategies for a long time to be a long-term investor. So buy and hold strategies, in our experience, don't produce the best returns. To be successful, you need to stick to the strategies even after the down years. So for 18 years now, I've been looking for, and continue to look for, the most successful long-term strategies that work in the stock market. I have still not found even one that every single year that I've looked at, it is where it doesn't have a down year or doesn't have a year where it fails to beat the S&P 500. All of the strategies, every single one that I've come across, has the characteristic that it will have one or more down years. So Joel Greenblatt, who wrote the book, The Little Book That Beats the Market, hedge fund manager, and again, one of the masters here, did a study. He found that on any one-year period, the strategies would underperform by 25% of the time, 1 in 4 times. There were 2-year periods that underperformed, so 17% of the times. But when you come to 3-year period, 95% of the times, the strategy will outperform the stock market, the S&P 500, over that period of time. Again, the key insight is, with strategies that are proven for the long term, you must stick with them over multiple year periods. Any 1-year period of time, you can have a down period. Now, what's interesting is, this is exactly the reason why these strategies continue to work. We are generally shaken out of strategies. Our faith is lost in a strategy if it has a down year. So I continually tend to reemphasize this for whatever strategy you pick it. As long as it's had a proven long-term track record, you want to stick through it through the down periods of time. One of my interests has been in behavioral finance and how investors are biased and how our brains are essentially wired. This is an all-day topic. I'm just going to condense it down to a few points. But as a whole, we tend to be more optimistic about our ability to, that we can find good stocks and actually do well with them. We're very overconfident that our judgment is right with the stock, so it creates an illusion of control. We tend to be highly, highly biased to what's recently happening in the market. Over the last few months, over the last year, these are still very short periods of time in the market, and we tend to hold on to whatever has happened last, or we project it into the future. And it's exceptionally difficult for us as human beings, and this includes virtually all the professionals in the industry too, to overcome that recency bias. We just strongly tend to feel what's happening recently in the market is what's going to continue. And then loss aversion is that many times we're actually far more sensitive to the potential of loss when something's going down than we are to the gain. So this creates a bias, asymmetry. When we're feeling about something, we're much more worried about the potential loss, and again, that shakes us from the confidence of staying with the strategy. And now that behavioral finance is probably at least 10 years old and relatively well known, you would think people knowing this could overcome these biases. Yet that hasn't happened. Our human minds still continue to do this when confronted with the stock market going down 20%, 30%, big market crashes. We still have these potential problems that we can't get over. So a Buffett quote on emotions and discipline: investing is not a game where the guy with a 160 IQ beats the guy with a 130 IQ. Once you have ordinary intelligence, what you need is a temperament to control the urges to get other people into trouble in investing. Portfolio construction, one of the other aspects here is that we hold portfolios of either 10, 20, or 50 stocks, depending upon multiple factors like the investment size. You also can't own the market by owning it. If you have 500 stocks in your portfolio that like mutual funds do, or even a couple hundred stocks, you're going to become the market as compared to being able to outperform the market. And one other criteria that we use is we generally tend to like to equally weight each of the stock selections. We find that that outperforms portfolios where they're very different sizes of the initial selection of the stock. So here's the key question. Once a strategy becomes known, the presumption is that it stops working. So do these investment strategies still continue to work today? And the answer is a big resounding yes. So just to give you the example, why is this and why do I say this? Out of the 11 master portfolios we're following, 10 have outperformed the S&P 500 since inception. Some doubling or tripling the S&P 500 return. These go back to, in this case, generally about mid-2003. The S&P return from about that time to today is approximately 5.1%. The best performing portfolio over this time actually has been the Benjamin Graham, with a return of just under 15%. Fisher, O'Shaughnessy, Zweig, Lynch all have excellent, outstanding compounded performances over this period of time. And the presentation also gives the other ones.